Pakistan isn't poor because it lacks people, resources, or potential. It's poor because its economy keeps hitting the same invisible wall, over and over again. In this video, we're breaking down why Pakistan, home to over 240 million people, has spent decades bouncing between bailouts, inflation crises, and currency collapses. We'll explore the structural flaws behind the headlines, how debt and politics trap the economy in slow growth, and why even massive rescue packages haven't fixed the core problem. And by the end, you'll understand why Pakistan's biggest challenge may not be money at all. On paper, Pakistan should be thriving. It has one of the world's largest populations, strategic access to China, Central Asia, and the Arabian Sea, nuclear power status, large agricultural output, textile exports feeding global supply chains. And yet, Pakistan's GDP per capita is still under $1,600 in nominal terms according to the World Bank. Foreign reserves regularly drop to just weeks of import coverage. Inflation has surged past 30% in recent years. And the country has gone to the IMF more than 20 times since the 1950s. So what keeps going wrong? To understand Pakistan's failing economy, we have to rewind not years, but decades. Pakistan's economy has followed a repeating pattern. Short-term growth, fueled by borrowing imports, surge, leads to trade deficit, widens, leads to foreign reserves, collapse, leads to currency crashes, leads to inflation, spikes, leads to IMF bailout, leads to austerity, leads to political backlash, leads to reforms stall, and then the cycle restarts. The IMF currently runs another multi-billion-dollar stabilization program for Pakistan designed to stabilize reserves, control inflation, and reform taxation. But here's the uncomfortable truth. IMF programs treat the symptoms. Pakistan's deeper problems remain. Pakistan does not suffer from one crisis. It suffers from structural weakness. Four forces dominate everything: chronic trade deficits, point 1 weak tax collection, point 2 debt-driven government spending, point 3 political instability blocking reform. Type 4 together. They trap Pakistan in what economists call a low-growth equilibrium. Let's break that down. Pakistan imports far more than it exports: fuel, machinery, fertilizer, food, industrial inputs. Meanwhile, exports rely heavily on low-value textiles, rice, and raw agricultural products. According to Pakistan's central bank and World Bank data, exports hover around $30 to $35 billion annually. Imports often exceed $50 to $60 billion. That gap has to be paid somehow, so Pakistan borrows, or relies on remittances from overseas workers. When those inflows slow, the currency crashes. In 2022 to 2023, the Pakistani rupee lost over half its value against the dollar, pushing import prices sky high and triggering explosive inflation. Fuel becomes expensive. Electricity tariffs surge. Food prices skyrocket. Suddenly, everyday life becomes unaffordable for millions. Pakistan's tax-to-GDP ratio sits around 9 to 11%, one of the lowest among large economies. Compare that to Turkey, approximately 20%, OECD countries, 30 to 35%. That means the state simply doesn't raise enough money to fund infrastructure, education, healthcare, or energy systems without borrowing. Large parts of the economy operate informally. Agriculture, over 1/5 of GDP, remains lightly taxed. Elites negotiate exemptions. Political pressure weakens enforcement. The result? Permanent budget deficits. And budget deficits mean more debt. Pakistan's public debt now exceeds 70% of GDP, according to IMF and World Bank figures. But the real killer isn't the size. It's the interest. A huge share of government revenue goes toward servicing loans, both domestic and foreign. In some years, interest payments alone consume over half of federal revenues. That leaves little money for schools, roads, water systems, industrial upgrades. So productivity stagnates, growth stays weak, and borrowing continues. It's financial quicksand. Few sectors capture Pakistan's dysfunction like electricity. Power generation is expensive. Transmission losses are high. Government subsidies distort pricing. Utilities accumulate unpaid bills. This creates what Pakistan calls circular debt, hundreds of billions of rupees sloshing between state companies, fuel suppliers, and banks. Factories face outages. Businesses shut down. Foreign investors hesitate. Every blackout quietly drags GDP lower. Then came disaster. In 2022, catastrophic floods submerged a third of the country. The World Bank and Asian Development Bank estimated damages above $30 billion. Crops vanished. Food prices jumped. Infrastructure collapsed. Government spending exploded right as reserves were already falling. Pakistan wasn't just fighting economic fragility anymore. It was fighting nature. Since independence, Pakistan has experienced military coups, short-lived governments, mass protests, court battles, policy reversals. Every new administration rewrites budgets, energy tariffs, and investment rules. For long-term investors, that uncertainty is poison. Factories take decades to pay off. Ports, railways, and grids require stable policy. Pakistan rarely offers it. Economists at the World Bank regularly emphasize that reform continuity, not emergency bailouts, is the real key to sustained growth. Compare Pakistan with Vietnam or Bangladesh. All had similar incomes decades ago. Vietnam focused on export manufacturing. Bangladesh built garment megafactories. Pakistan? It remained stuck in low-value production, limited technology upgrading, and protected domestic industries. High tariffs shield inefficient firms. Complex regulations discourage startups. State-owned enterprises drain budgets. Instead of becoming a manufacturing powerhouse, Pakistan plateaued. Every crisis eventually reaches the same moment. Foreign reserves fall to a few weeks of imports. Credit rating agencies downgrade the country. Shipping companies demand cash up front. Fuel shipments stall. Banks panic. And the government walks once again to the IMF. In 2023, and again afterward, Pakistan secured multi-billion-dollar IMF packages to prevent default. But these come with conditions: raise electricity prices, cut subsidies, increase taxes, liberalize exchange rates, tighten budgets. Short-term, these stabilize reserves. Long-term, they anger voters. Protests erupt. Politicians soften reforms. The program loses momentum, and analysts warn the cycle could repeat. Reuters and World Bank reporting consistently note that without lasting structural reform, especially tax expansion and export diversification, Pakistan risks recurring balance of payments crises. This is the knife-edge moment. Reform deeply, or remain trapped. Pakistan's failing economy is not about laziness. It's not about lack of talent. It's not about geography. It's about a system stuck in loops. Borrow to spend, import, to crash, to bail out, to repeat. Until Pakistan broadens its tax base, stabilizes politics, fixes energy markets, moves up the manufacturing ladder, and invests in productivity, growth will remain fragile. The tragedy is that the potential is enormous. A young population, strategic trade routes, agricultural depth, industrial foundations already in place. The story of Pakistan's economy isn't finished. But right now, It's balanced between reform and relapse. And if you enjoyed the video, make sure to like and subscribe, and check out the channel to find more amazing and new videos. Pakistan